In this video, we will look at the bear separating line. We have already looked at the bull separating line pattern. So this is just the opposite of that. This is a daily time frame chart of ICICI Bank. So let us look at the characteristics of this pattern. Number one, it's a continuation pattern. Okay. So it should come after a downtrend. So that's point number one. Point number two, it's a two candle pattern and both the candles must have almost the same opening price. Okay. So the psychology here is the market is coming down, suddenly the bulls become active, but by the time the next candle opens, the bulls are scared, and by the time the second candle closes, the bulls have completely given up. So when two candles have almost the same opening price and opposite color, that's called as a separating lines. And there are two versions of this pattern: the bull separating line and the bear separating line. As you can see here, the bear separating line is signaling a top here. Generally, the bear separating line is used in a downtrend. In a downtrend, you get a green candle where people become optimistic. But the moment the second candle closes down like this and has the same opening price, that is an indication of a disaster that is going to come ahead. Okay. Ideally, both candles should have tall real bodies. Every candle pattern, as I have discussed before, every candle pattern has got an ideal version and a variation. This is a variation because the two candles do not have the same opening price. Moreover, this candle has a longer than required upper shadow. Ideally, both candles should, the body should be near the ranges. So, for example, this candle would open near the low, close near the high. This candle would open near the high and close near the low. The shadows should be smaller and the candles should be taller. That's the ideal version. I wouldn't use this pattern to initiate a trade. I would use this pattern to stay in a trade. So, for example, if you were short on this stock for some reason, then the appearance of this pattern gives you more reason to remain short on the stock, not to close the or cover the position. Okay, because it's a very dangerous, very strong continuation pattern. As you can see here, the price continues to go down in spite of the fact that the price collapsed a pretty large percent in a single day. Okay, so that's the bear separating line. You can have a look at this pattern in detail on this link. Go to the Japanese candlesticks trading mastery program. I have explained this in great detail there. So it's an important continuation pattern, but please understand it's a rare pattern. Okay, generally not used to initiate a new trade because of the reward to risk problem. Here, if you were to initiate a trade, the entry point would be this and the stop loss would be somewhere here, and that is not a good reward to risk ratio trade. So this is used to manage positions, not create new positions.